China's economy is witnessing a slowdown in consumer spending. It has slowed down, and this is concerning lawmakers in Beijing. The festive season also did not bring much of a joy here. In October, retail sales were expected to rise just 2.8% compared to the previous year, marking 5 consecutive months of deceleration and the lowest annual increase in over a year. But why is this actually happening, and how will it impact the growth of the country? Here's a report.
China's economy, once a global engine of growth, is now struggling with its slowest consumer spending momentum since the pandemic rebound began fading over 4 years ago. In October, retail sales were expected to rise just 2.8% compared to the previous year, marking 5 consecutive months of deceleration and the lowest annual increase in over a year. Economists say this trend results from a high base effect and 1 fewer working day. But more fundamentally, it spotlights deep-seated problems: stagnant household incomes, a lackluster job market, and persistent anxiety among consumers. The government in Beijing has repeatedly called for stronger domestic demand and recently renewed pledges to significantly boost the consumption share of GDP. But household caution remains high. The latest data reveal that spending during October's National Day holiday, traditionally a major shopping and travel period, fell short of last year's already modest numbers. Targeted consumption subsidies on items like electric vehicles and home appliances have provided only modest relief, as the broader problem is still weak wage growth and fragile job prospects. Manufacturing and exports still offer some comfort. October's industrial production, while slowing to 5.5%, continues to be among the world's fastest. And China's exports, though recently experiencing their first dip in 8 months, may rebound as global demand for AI hardware and electronics grows in 2026. Analysts suggest that overseas markets could help offset China's soft domestic demand for some time, though the risk of external shocks remains. By contrast, the property market remains a drag. Fixed asset investment shrank 0.8% in the first 10 months of 2025, and property development continues in double-digit contraction, a major blow since real estate has long been synonymous with household wealth in China. Government moves, such as an extra 1 trillion yuan in fiscal measures for local projects in city budgets, might eventually stabilize growth. But these policies take months to impact the real economy. Despite the challenges, projections suggest China can still achieve its full-year target of around 5% GDP growth, with consensus estimates pointing to 4.9% next year. However, the story is increasingly bifurcated. Manufacturing and exports remain resilient, but a true, sustainable recovery will depend on policies that bolster wage growth, restore consumer confidence, and fundamentally shift China toward a consumption-driven model.
If you like this video, then like, share and subscribe to ET Now.